The housing market never used to be this crazy. Go back 50 or 100 years and you probably know that you could have bought a home for a few $1,000s after a quick meeting at the bank. But over the last 30 or 40 years, housing prices have been accelerating, going up a crazy 20% in the last year alone. Now, while anyone can Google that and see the data for themselves, not many people actually know why the housing market is accelerating like this. And that's where George Gammon comes in. In a video I'm about to show you clips from, he does a great job in explaining why the housing market used to be so much cheaper and why it's so ridiculously expensive today. But really quickly, if you're new here, subscribe to the channel. We're putting out loads of videos just like this constantly that you don't want to miss out on.
Do you think there's going to be a giant crash coming? Do you think that, are you more along the lines of other YouTubers where they think that it's not going to be more so of a crash? It's going to be sustainable for a very long time. Where do you stand on the housing market potential crash?
I look at everything from a standpoint of macroeconomics. So usually when I have a take on the housing market, it's a bit different than your, let's say, typical YouTuber who's talking about the real estate market, because that's their specialty is real estate, but they might not understand the macroeconomic history and how that pertains to prices. So the first thing that you have to ask yourself when you talk about the real estate market crashing, quote unquote, is, are you talking about crashing in real terms or nominal terms? Because prices can go down in real terms while at the same time go up in nominal terms. Most people just consider prices going up or down. They just look at the nominal. They don't adjust for inflation.
So George straight away makes the very important point that everything needs to be adjusted for inflation. House prices may rise by 10% over a certain period, but if incomes, rents, food prices and commodity prices and everything else that makes up the economy also rise by 10%, then those homes are not any more expensive than they were before. They've just had their prices inflate with the rest of the market. This is something that a lot of people miss or overlook, but it's even more important than usual as the US has just seen year-over-year inflation of 5%. Meaning that everything in the economy has risen in price by 5%, not just housing. Now, I do feel that it's important to note that house prices have risen by a lot more than just 5%, so there definitely has been a housing boom in both real and nominal terms, but the real figures aren't quite as high as the headlines might suggest.
But the reason it's so important to adjust for inflation is if you look at a chart going back to 1900, you see, when you adjust for inflation the size of the home, you see that prices didn't change for 100 years. They were the same in the United. Everyone thinks that prices go up over time. No, they don't. Housing prices don't go up. They inflate, meaning they don't appreciate. They just go up with the rate of inflation, which makes a lot of sense because usually inflation goes up with wages or wages go up with inflation. There's a little bit of a lag there. And usually interest rates are relatively constant. They fluctuate a little bit here, but they generally mortgage rates hover around, let's call it 6, 7, 8%, something like that historically. So if you've got a pretty consistent mortgage rate, and if you've got incomes going up with the rate of inflation, and income is part of the equation for the mortgage payment, then it would make sense that housing prices stay pretty consistent as long as lending standards stay consistent as well, which we saw through that 100-year span where you had to have 20% down payment, you had to have a good credit score and all those things that are now just kind of antiquated, to say the least.
So next, George goes on to explain that if we look back at our housing markets pre-2000, housing prices didn't really rise like they have done recently. Sure, they would sometimes rise by 3 or 4% in a year, but only when wages or inflation rose by that same amount in that year. Now, George is totally right about this. If we look at the historical data, housing prices have pretty much stayed constant with inflation, and he touches on why this is, but he doesn't really elaborate too much. The real reason housing prices didn't rise in the past is because there was no way for them to rise. In the past, you might have needed a solid down payment of around 20%, but there were never any opportunities to buy with 3.5% down like there are now. There were also consistent interest rates at around 6% for pretty much the entirety of the 20th century. Now, these two factors right there meant that the costs of buying a home remained constant. You would always have to save up 20% for a down payment, and you would always have to pay 6% interest on your mortgage. The only way for house prices to rise was for wages to increase. If the average wage only increased by 2%, then it would be impossible for the average person to buy a house that was 5% more expensive. Because these factors, interest rates and down payments, remained constant for decades, the only way to spend more on your housing was to earn more money. That's why in the past, housing never really got any more expensive than wages did. Now, the unique thing about the housing market is that on average, people spend as much as they can on housing. People rent the nicest apartments they can afford and they buy the biggest houses they can afford. Now, this makes perfect sense. Where we live is probably the most important thing for the vast majority of people in their lives. It has a huge impact on our happiness and our quality of life in a way that nothing else really comes close. If I get a 50% pay rise at work, it's very likely that I will go out and rent an apartment that costs 50% more. On the other hand, it's very unlikely that I will go out and spend 50% more on bread or milk. This causes housing costs to be directly tied to wages in a way that no other good or service can really compare.
Then what you saw in the beginning 2000s, when you're looking at that chart, even adjusted for inflation, is you see just this parabolic kind of hockey stick, which you would imagine, that peaks out in 2006 and then comes down, 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 down until it bottoms out in 2012. Now, where do you think it bottomed out in 2012? Kind of a rhetorical question. Of course, it bottomed out right on its historic trend line going all the way back to 1900. And why? It makes sense because it just adjusts back down to the level of incomes and to where we don't have all the froth with the excess debt that was issued because of the loose lending standards and because of the artificially low interest rates from the Fed, et cetera, et cetera.
So, in the past 40 years, house prices have been increasing in value faster than wages. Now, someone has to be buying these houses, so people have to be able to afford these prices or else the prices would just fall back down. So the question is, how are people affording more expensive homes when their incomes aren't rising at the same rate? Well, the answer is that our mortgages have been getting cheaper and cheaper due to lower interest rates, and the lending requirements for getting mortgages have been made easier as well. Most notably with smaller deposits like 3.5% down FHA loans. In the past, being able to spend $1,000 a month on your mortgage would have gotten you a loan of $100,000, whereas due to today's low interest rates, that same monthly payment might get you a loan of $300,000. The amount we spend on our housing every month hasn't actually increased any faster than our wages. What has increased is the amount of money we are able to borrow to buy these expensive homes.
So in order to have the same type of I don't want to say data, but the same type of price action that you have seen in real estate over the past, let's say 20, 30 years, you would also need to have the same action in interest rates. Now, you may believe that interest rates are going from zero Fed funds down to -4, -5%. I don't know. I think that's a question of probabilities. It's definitely not a certainty. And then what you would need, either or, you need the income levels to increase significantly. Well, income levels are not increasing significantly other than through transfer payments. Now, it is true that incomes have gone up from 2019 to 2020 while unemployment levels have gone up because of the additional stimulus and the additional unemployment checks and whatnot. But that's now whether that filters into the real estate market, I definitely think it has. But will it continue? I don't know. It depends on if the stimulus continues and when, what direction that goes. So at the end of the day, the long term, if you're looking at the next 6 months, the next year, listen, you just really can't tell these things. But if you look at the next 10, 15, 20 years, at some point in time, we will have to revert back to that historic trend line because it's just based on incomes and just based on interest rates and whatnot. So, but the question becomes, do you go back to that trend line in nominal terms, meaning prices, just the prices people see their houses listed for on Zillow or whatever, or on the MLS, do those go down by 50% over the next 6 years? Or do they continue to go up by, let's say, 3% per year, while inflation goes up to 8% per year? So there's a 5% delta. And if you compound that 5% delta, let's say over 10 or 15 years, even though prices nominally have gone up 3% per year, prices will have gone down by 50% in real terms. And then they would have gone down to that historic trend line.
So what George is saying there is that in order for house prices to continue to grow faster than our wages, interest rates have to keep getting lower and lower, and lending requirements have to keep getting wider and weaker. If that doesn't happen, then these house prices will prove unsustainable and will at some point fall. Now, this is where the real problem rises. Interest rates are already at 0% in dozens of countries around the world. They can go negative, but that's a whole other ball game and something that no government really wants to see happen. Lending requirements can't really get any lower than they already are either, at least without widespread fraud and irresponsible lending like we saw in 2007 happening again. So it's very unlikely that this trend of housing prices growing faster than wages is going to continue. And in fact, it's very likely to go in the opposite direction. Prices are likely to fall back towards that historical average. Now, George made another good point, that this fall in prices can happen in two ways. Firstly, prices could fall in nominal and real terms just like they did in 2008 to 2012. Or, secondly, they could continue to increase but at a rate lower than inflation and wage growth. If our salaries and inflation grow at 8% every year but house prices only grow at 2%, then houses are actually getting 6% cheaper every year, and before long we would be back at reasonable housing prices. With the 5% inflation the US has seen over the last year and the continued money printing that means that inflation is likely to stay, this is a very real possibility and something that we should all be prepared for. Now, there is one final thing that I want to bring up that George has missed, and that is investors. George is totally right that normally housing is entirely dependent on wages, but when investors get involved, everything changes. Investors don't allocate a certain amount of their salary to their housing costs, and they don't have to see salary increases to buy more expensive homes. The demand that they create isn't driven by the same things that drives demand amongst normal people. It is entirely possible that house prices have been driven up by investors and that the link between wages and prices is severed, meaning that interest rates, down payments, and average salaries won't have any effect on housing prices. This is going to be especially true for really hot international markets like New York, LA, or London, where people from all over the world flock to buy up homes. But it's going to be much less prevalent in more grounded markets like the American Midwest. This is something I plan to cover in more detail in the future, so if you're new to the channel and you enjoyed this video, then hit the like button and subscribe so you don't miss my future videos. If you want to invest and protect your hard-earned cash in stocks, shares, real estate investment trusts, cryptocurrencies, or commodities, then there's a link in the description and the comments to Webull, a brokerage where you can get 2 free stocks, each worth up to $300 when you sign up with that link. Thanks for watching. Until next time.